It is actually one of our big focus areas as well at 9.9. And I'm going to take 1 second to show you something that we feel very proud of having launched very recently. It applies to you as any kind of professional. And if you have any interest in one day becoming an entrepreneur, or you have entrepreneurs in your family, mid-sized companies that you grow with, then this is what you should look at. It's called Mind Your Business. We have a publication called Inc. India, which for the longest time is been serving India's entrepreneurs and mid-sized businesses. We launched this just last week. We've had such an incredible response to it in terms of feedback on the design, on the quality, on the content, that I decided to take a minute and feel proud and tell you to log in if you can, like us on Facebook, which is the new way to ask for your support, and do give us feedback on what you think of the site. Will you also just, I forgot to thank Rakesh, so please join me in thanking Rakesh for his presentation. I'd now like to move on to our next session. It's called Behind the Scenes, Preparing for Hypergrowth. The idea of this session is really what happens when companies are looking to chase high growth. Investors always look to back companies that are actually scalable. What is it that they look for when they decide to back a company which has the potential for scalable growth? What are the things that they look to detect whether a company has the potential to grow? Firstly, whether it has the opportunity, then does it have the potential and the ability to execute, and finally actually to be able to absorb that growth. Sanjeev Agarwal, who's also 9.9's investor, but the co-founder and senior managing director of Helion Ventures, he has an incredible life story. After being a corporate professional for a long time, he set up Daksh, which in some ways pioneered the ITES industry in India. It was bought by IBM. It was a huge story in those days, and then he set up Helion Ventures. He's obviously a very successful entrepreneur, and he is uniquely poised, in my view, to comment on hypergrowth and talk about what he thinks prepares a company for hypergrowth. Before I invite him on stage, there's a poll question up here. Can you all very quickly name some companies that you think failed because they grew too fast? And when you type in your answer, please type in the name of the company. We've been having trouble with the poll because instead of typing A, B, or C, you type the word and it doesn't recognize the response. So the instruction of how you should answer the question is in the question. But here, please quickly log on and type in some names of companies that you think failed because they grew too fast. With that, please join me in welcoming Sanjeev Agarwal to talk to us about preparing for hypergrowth. Right. Satyam, Suzlon, Kingfisher Airlines, Shubhiksha, Nokia, Goldman Sachs. My God, that's a very long line. So with that, Sanjeev, can I invite you up on stage too? It sort of sets the stage to talk about what?
Can somebody help me with the presentation? press to go forward? Okay. Okay. Any guesses on why those companies failed? They didn't have good CFOs. So as you know, we are venture investors in 9.9. You got it. We are venture investors in 9.9 and we have about 50 portfolio companies. And we have trouble finding CFOs. So when Anuradha called me to speak at this forum, I thought, where can I find 100 CFOs in one room? So it's a great place for headhunting. So I think, thank you Anuradha for setting this up. And I will talk to you about my experiences from two different dimensions. By the way, I'm also joined by my colleague Natarajan, who is the CFO at Helion, Nats as he is called. I think many of you know him. And I will talk to you from two dimensions. One as an entrepreneur, which I did for about 6 years, and then as an investor in technology sector for last 8 years. And I must say, I'm more biased towards services and technology because that is my background. So some of the things that I would talk of may not be very relevant to manufacturing. I don't know whether this audience is more manufacturing or services. By show of hands, can you raise your hands, those who are in manufacturing? Okay, so I think it's a good mix of manufacturing and services. So I think in our business, actually it's fairly simple. We bet on the jockey and the horse. That's the terminology we use in our industry. Jockey being the management team, which is building the business, and horse being the market or the opportunity that you are trying to pursue. So the market that you're trying to go after and the team that is going after. So that's the valuation that we try to do. And in most cases, they are very forward-looking bets because these businesses that we invest in are less than $5 million. So it's pretty much based on the potential of the market and the team. And I think in a year we see about 1,000 odd proposals, and we invest in 7 or 8 companies on an average. And one single biggest factor for which companies get rejected is that many markets that they are pursuing are not large enough. Simple thumb rule is that if you participate in $1 billion market, then you can create a $100 million company if you take 10% market share. But it's very hard to find under-penetrated $1 billion opportunities in India. You take China, equivalent companies typically 5 to 6 times. We are investors in Make My Trip, which is a $1 billion market cap. Their equivalent in China is a company called C-Trip. That is $7 billion market cap. And I can give you examples galore. That this is our biggest challenge, that the economy is just not large enough to yield a lot of companies that can participate in large and growing markets. Our thumb rule is that GDP grows at about 7 to 8% in good times, and hyper growth sectors, let's say healthcare, technology grows 2x, which is 14 to 15%, and leaders in those sectors should grow 2x of the sector. So if we can find companies that can grow 30 to 40% per annum, then we believe that we can create serious shareholder returns. So some of the interesting characteristics that have worked for us in companies that we've invested is one that scalable companies tend to be pretty early to their markets. I think a very good example would be Flipkart, which entered e-commerce in 2008 and has only enhanced the lead over last 5-6 years, because there are many sectors where it's a winner take it all market. So if you don't get out quickly enough, you probably lost the race. We have a business in our company in our firm called Azure, which is a solar power producer. They started out in the year 2008 when solar had just about started in the country, and over last 6 years they have maintained their leadership. So I think companies getting early into a large market has a pretty good chance of success. Very rarely do they get toppled. So leadership position is very hard to unseat unless you are up against a competitor like Reliance, which can just overpower you with the power of capital. Other things I think the large scalable companies, hyper growth companies do very well is to launch new service lines or new lines of business very, very effectively. A good example would be again Make My Trip, which was very dependent on the air business. And as you know, when the power shifted to the airlines, their commissions plummeted. And they did a very good job of shifting to hotels and packages, which kind of created a lot of value in the company. So I think hyper growth companies are also very good at navigating new service lines when the existing ones are running out of steam. And these are more extensions because airline and hotel, in a way you are selling to the same customers. So I think they capture adjacencies very effectively. I think global is a 10x factor. As I said, China companies are 7 times Indian companies. So if sometimes you are serving a local market, you just don't have a large enough canvas. I think a greatest example of this is a company called InMobi. Does that sound familiar to any one of you? It's a mobile advertising network. It basically brings publishers and advertisers together. And they were struggling for growth till they were serving Indian market, because mobile advertising in India is a very, very tiny piece. And the day they went global, starting from South Asia to Europe to United States, they grew like a rocket ship, and they are now valued at $1 billion plus. Zomato, I think if you go to find your restaurants, the restaurant review site is another very good example of somebody who's finding that domestic canvas is just not large enough. So you enlarge your market by getting into global arena. So that's the other things that scale companies, hyper growth companies do very well. What do I keep doing? And I think the other very interesting way to make sure that you're relevant is to what is called in our industry pivot. So I will give you an example of the business that I was involved with, Daksh, which is a business, outsourcing business. And our business model was very simple. When internet was growing very rapidly, folks like Amazon and Yahoo would get a lot of emails that the companies just didn't have the wherewithal to answer. So we went to Amazon and said that why don't we send all the emails through electronic links to India, and we will provide answers to those emails. And that business did very well for a couple of years. And then the entire .com bust happened. So internet didn't grow at the scale at which it was expected, and we virtually were staring a very difficult situation. So we pivoted to a voice business. So we went to customers like Citibank or Sprint, whose customers call them on telephones, and we said that we will route your calls to India and then have Indian agents answer your calls. And we saw scorching growth when we made that pivot from being an email-based service center to becoming more a voice-oriented service center. Another very interesting pivot that comes to my mind is a portfolio company of ours called United Lex. It's in the legal outsourcing industry, and they are trying to help chief of legal staff lower the cost of legal bills in US by moving work to India. And the first service line they went after is contracts administration. and had a lot of difficulty in growing. That's a business we funded, but that business was not growing at the pace at which we were expecting, because we found that contracts work in a large company was very distributed. So you had to sell to many stakeholders, and that had a lot of friction. And they then found that one area which was centralized in a firm was litigation. So they moved from contracts work to litigation, and then again it developed a very interesting trajectory. They are a $100 million company in about 6 years, and we funded them when they were pre-revenue. So I think that is the other thing that a lot of entrepreneurs who are building scale companies are very good at, that when one market is not working, they kind of figure out where next to go rather than persist with the same idea. So the key terminology in our world is fail fast, because you have limited capital, you want to do experiments very, very quickly. Don't hang on to your same business model for far too long, because the money is going to run out, because investors in some ways drip feed. They give you few $1 million, they want to see the results, then they'll give you some more money, and then they want to see more results. So if you don't put money to good use, then you are running out of capital. So I think successful entrepreneurs are very good at discovering new markets. So I think this was the first theme of scale companies, that they are very good at finding their opportunity space, where to play, what is their arena. And once the business model is validated, then you can apply acceleration, which is where the execution comes into play. So I think first very important theme is get your business model right, make sure that there is a product market fit. You are in a market which is large, which is growing, which is scalable, where you are early. And when these conditions are met, you have some recipe for success. It's not a guarantee, because you still have to execute, but at least you are in the right playground. The second, I think, very important piece is the team, and some in the venture world believe that team is even more important than opportunity, because if you back a good team, they will spot the right opportunity even if they started with the wrong one, and I gave you some examples. And in team, I think the best example that comes to my mind is 3 companies that started concurrently in the IT sector. Are there any IT sector CFOs here? So you folks would know. 3 companies that started concurrently, Kale Consultants, Mastech, and Infosys. They all started in 1975, and they had access to exactly the same market. They were trying to pursue North America, and they had access to the same labor pool, which is they were using Indian talent. 25 years later, what do you think happened to these 3 companies? Any guesses? Sorry? Yes. So 25 years later, Kale Consultant was 100 crores, Mastech was 1000 crores, and Infosys was 10,000 crores. So they were exactly in the same industry, using the same resources, but it was the leadership at the helm which made all the difference. So which is the point that some investors believe in, that team is even more important than the market that you pursue, because here is an example of same market but very different outcome because of the better quality of team. And I think in my head there are 3-4 very important characteristics of the team, and to me this is the biggest one, that most entrepreneurs who scale companies, the founder or the CEO or the management team have very high aspiration. Their aspirations are much greater than their resources. And the best example of aspiration greater than resources is this small company which started in China. Now you are familiar with that company, it's called Lenovo. I don't know if you have studied Lenovo as a business. About 30 years back, Lenovo used to distribute IBM PCs in China, just the way Airtel has distributors in India, in different parts of the country. Lenovo was doing the same for IBM. And 30 years later, to talk of aspiration of the entrepreneur, what happened? Can you guys guess what happened to? So Lenovo bought IBM. It's like Airtel distributor buying Airtel. And today Lenovo is a global business. It has R&D in North Carolina. It is listed on Hong Kong Stock Exchange. And it is a multi-country global play. From being a distributor, you become the principal. So I think that's a great example of aspiration greater than resources. And great entrepreneurs who are scaling companies, they really see far, far out. And our belief is that capital will follow if you demonstrate these characteristics. And the other belief we have, both based on the portfolio companies that we work with in Helion, and when we look at successful companies, there is a very interesting combination of Brahma and Vishnu in every company. Brahma is the creator. It is the gentleman who's the visionary, who's looking forward. And then there is the Vishnu who maintains the universe. So this is the combination of a CEO and a COO. So you can think of Mukesh Ambani and Manoj Modi in Reliance, Sunil Mittal and Akhil Gupta in Bharti, Sanjeev Bhikchandani and Hitesh Oberoi in Naukri. You look into any scale company, there is always this team working in tandem. A creator who's thinking of new business lines, new business models, enlarging the market, and somebody who's then converting the creation into execution so that the wheels don't come off. I can bet you, if you were to analyze the first set of companies that Anuradha laid out, apart from the fact that they don't have any women CFO, they also didn't have this combination of Brahma and Vishnu. So the entrepreneur himself was the Brahma and the Vishnu, which is a very, very hard thing to happen. So I think for scaling and for delivering hyperscale, teams have to have this combination of creator and doer. And the third characteristics that we see in teams is that people are good first principle leaders. I think a lot of companies make mistake of hiring for relevant experience. Our belief is that if you get first principle leaders, they will adapt in any environment. But if you end up hiring for relevancy, you will end up discounting on quality of pedigree. And therefore, that is a mistake that a lot of companies make. So scale companies are very good at making sure that you hire good strategic thinkers, good leaders. Don't worry about where they come from. When we started Daksh, the first rule was that in our management team, nobody was from BPO, because we believed that the guys with BPO will come with a very biased thought process. We wanted a fresh look. So neither me nor any of our colleagues, founders and the new management team that we put in place came from this background. So I'm a big believer that scalable teams also demonstrate these characteristics. So these were a few top level thoughts on execution. Anuradha, how am I doing on time? Okay, so I have few more slides, can I? And then the third piece is, once you've got the market sorted out, you put the right team in place. Third piece is, how do you go about building the organization? And I will talk about a few constructs that are very dear to our heart. at Helion, which we think work in a scale paradigm. I think the biggest driver of scale in a country like India is how can you let go. So when you are growing 100% year over year, how do you create a structure which is not one company but many small companies? There was a time in the history of Daksh when we were a 500 people company and we got a contract for 1,000 people and we had to implement that contract in 6 months. Otherwise there were very, very strong penalties for delayed implementation. And at that point in time we moved to a business unit structure from a functional structure where each business unit had everything, HR, delivery, finance, technology. So we created mini CEOs and we experienced very strong growth. It does create some additional cost in your organization, but I think that additional cost is more than offset by the fruits of a growth that you can experience, because the organization is not burdened by one individual. It is not centralized. So there are many growth engines chugging along in parallel. And you want to make sure that when you decentralize, which is probably what happened in Subiksha, I'm guessing, because it's a very distributed business, you still want to make sure that there is a lot of accountability. So there is loose, which is decentralization, but there is tight, which is that you have very strong governance process, so that the wheels don't come off when these federated centers begin to run their own empires. But I think decentralization is a very good way to cope if you are in a high demand situation. I think the toughest thing that entrepreneurs and management teams like you do or you have to do or demonstrate is that at different stages of building an organization, which could be starting with a small market, going global, going multifunctional, is to restructure the core team. Because the people that you started out with are the people that may not be relevant for the business anymore, because they have run out of gas. So you owe it to the people in the team and you owe it to the opportunity that you make those changes very, very quickly. And I think that is where a lot of companies fail, that they don't iterate the management team fast enough. And good companies are very good at iterating very quickly by not letting go of people, maybe giving them different type of roles, but making sure that you upgrade the horsepower very rapidly. And this would be true for a function as much as for a company. So I think restructuring the core team at different stages. And when you let go, I think the discussion which was happening about responsible growth versus irresponsible growth, my belief is if you build a common value system and a culture which embeds that value system, then you can very easily let go, because that is the invisible hand that drives consistency of execution. So I think scalable companies have to install a very strong value system embedded in your hiring process, embedded in your training process, embedded in your performance management system, so that that becomes the consistency factor that is driving your growth rapidly. And last, I think a few slides. So you have market, the team, how you think of your organization paradigm, and a few nuggets on execution. I think this is, to my mind, the answer for responsible growth, that you have to focus on growth, efficiency and foundation concurrently. You can't do them sequentially, because if you focus on efficiency and growth, then you deliver a profitable growth. And when you focus on foundation, then you drive a sustainable growth. And the way to do it in a fast growing company is that you have people focused on these aspects. So CFOs, for example, are excellent at driving efficiency and ERP system, making sure that there are tight cost controls, foundation, which is things like compliance. So if you have different people focused on different dimensions, you make sure that when you're growing very rapidly, the wheels don't come off. So I think that is one very important aspect in execution, barring a few businesses, let's say like e-commerce, where there is a very big advantage to leadership. I think most businesses should consider having these three rhythms run concurrently and different stakeholders for these three. CEOs are anyway naturally growth leaders. So I think the rest of the management team, chief quality officer or chief financial officer, has to chip in to make sure that there is no derailment when you grow rapidly. I think this is a very obvious one. CEOs are very, very intuitive, and when you want to drive growth, you want to make sure that decision making is very, very data driven. So I think finance function actually plays a very important role in companies' data centricity, if I may. And I think this is the last point on execution: maniacal focus on customer satisfaction. And there are two parts to customer satisfaction. One is the external part. I think that happens by default, because we know if we don't serve our external customers, our business is not going to grow. So that is table stakes. What is more important is internal customer satisfaction. So whether the shared services functions like HR and finance are as customer oriented as the service delivery functions, I think that is where companies falter in the phase of growth. And you want to make sure that you send a lot of people from customer facing functions to back end functions, because they are already tuned to looking at things from a customer perspective. We used to have this saying at Daksh that there are only two people who work in this company. There are those who serve customers, and there are those who serve customers who serve customers. So if you don't belong to either of the two, then you don't belong here. And I think that keeps the entire organization in very good rhythm. Nothing breaks. I think capitalization, you're all aware of. You need capital to grow company. So you have to have the right balance between dilution and raising money. And I think we talked about that these are some of the things where CFOs can play a very, very active role. With that, I'll end the presentation. Thank you.
Lots of wisdom there. Questions? Yes, Joy.
Anyway, thanks for a very interesting presentation, and definitely the pearls of wisdom. Sanjeev, but very often, right, a business cannot run by its own rules. Circumstances force you to run the business by somebody else's rules. A case in point is e-commerce today. Very exciting, lots of news, lots of write-ups, huge amounts of funding coming in. But you know, people like you who are inside the industry know what's happening to the funding. They're building, of course, technology, they're building processes, they're doing all the right things, etc. But everybody wants to be bigger than the others. So they're throwing capital, they're discounting and selling. And everybody wants to wipe the others out by the capital play. Right? In such a case, if you're in such an industry, supposing you had a portfolio company, how would you view that portfolio? Would you invest further, or would you say no?
Why do you guys think is Flipkart successful? Let me ask a counter question. Yes.
Oh, maybe it's Tiger Fixel is driving it.
Sorry.
It's Tiger Fixel. The junior tiger from New York is driving it.
Sorry, Anuradha, can you translate if you don't mind?
He was referring to Lee Fixel from Tiger.
Yeah.
But, you know, it's not the subsequent rounds. Tiger is not funded. Other people have funded. Naspers is funded.
Yeah.
Somebody else is funded.
Yeah.
But the point is Flipkart really successful? I think the jury is out.
Yeah.
Time will tell. 5 years from now, probably we can say yes, it was successful or not. Now it's, you know, on a very high risk. It's like China. It'll either become huge or it'll fall by the wayside.
Right.
So one cannot, you know, take a call today as to whether it's successful or not successful. I was asking you as an investor, supposing you were an investor in such a company, right? What would your view be? You double down? Would you encourage them to go down this path?
So my belief is that Flipkart is a very successful company. And the reason is that they ship 250,000 packages every day at your doorstep with a great customer experience. Now, 250,000 packages which are being delivered to customers are getting customers hooked to Flipkart interface. And when the next time you want to buy something, your automatic choice is that you will end up going to Flipkart. So there are many of these winner take it all markets. I saw this when we were investors in Make My Trip, that there was exactly the same price war that you are seeing in e-commerce now. And we continue to back Make My Trip. Why did we decide to continue to back Make My Trip? Because it met a lot of these characteristics that we talked about. It was in a large market, it was early, it was leader, but it was maniacally focused on customer satisfaction. So,
discount. If you scale back the discount, sales fall, drop. We've all seen it happen. You again increase it, again sales rise. Yeah. People come to you because, you know, they're getting a good deal.
Joy, the debate on that you have over a drink and dinner.
Okay.
So I'm going to give a chance to some others to ask questions before we close the session. Any others? Yes.
Yeah. Hi, thank you for the presentation. I just wanted to highlight the role of the CFO in this particular slide where you spoke about governance rhythm. So my question is basically going back to the debate on governance versus growth. And is the CFO really focusing on governance, or is it just another tick in the box, you know, just a checklist where governance is ticked and then he focuses on driving growth? What's your view?
my view is that CEOs naturally are very good growth leaders. So CFO's job is to temper them down and make sure that they are the custodians for the other two dimensions of growth, which is the responsible growth, efficiency and foundation. So for efficiency and foundation, I see CFO as a sponsor, as an owner. And for growth, CFO has a very active support role to play, which is around resource allocation and prioritization. That if I have $100 million, should I put it behind airlines or should I put it behind hotels? Because CEOs are very, very intuitive, not at all data driven. And CFO has a very strong numerate mind. So I think that is where you play a support role. But in the governance and efficiency, you should play a lead role. At least that's the way I look at a CFO role.
Thank you.
Very quickly, last. Sorry. Of course we'll share this. Of course we'll share this. Okay. Yes. Last question.
So firstly, thank you. You put it very simply and helped us all in finance to relate to a lot of things that we probably tend to look at in a complicated way. My question was also from a role of a CFO. Would you consider the role of a CFO to also be a change agent in a scenario where there is a hyper growth situation and the CFO is trying to work with the CEO to also match what the specific business needs to do? What is it from a country standpoint? How does it from a corporate office standpoint? So didn't see it here, so just wanted to get your thoughts on that.
Did you get the question? Can you?
Yeah, she's just asking that in a hyper-growth environment, does the CFO also play a change agent in the context of geography?
I mean, I don't have a very good answer to your question, to be honest. I would still say that these are the few things that CFO would be very good at, making sure that capital is going to the right places, profitability is not disturbed. So for example, in e-commerce, I'll tell you what should be the CFO's role. CFO's role should be that unit economics are not disturbed, the point that Joy was making, that people are doing indiscriminate discounting. I think CFO is a very good custodian for gross margin, to tell the CEO that even when you want to grow very rapidly, you can put cost in SG&A, but never let your gross margin go out of control, because that contaminates the business model. So it is a very Brahma and the Vishnu combination in most situations.
Thank you, Sanjeev. This is a great session. Please join me in thanking